The stock market is a place where every investor dreams of accumulating higher returns and booking massive profits. Investors are primarily focused on gaining from increased share values, as this is their primary goal. However, that's not the only way to earn money and book profits in the stock market. Investing in dividend stocks is found out to be a good and easy way to reap a steady and consistent source of income. If you're looking to invest in dividend stocks, join us as we give a clear understanding of why you should consider investing in dividend stocks. So before we get started, make sure you like, comment, and subscribe to stay updated on our future videos. But firstly, what are dividend stocks? Dividend stocks usually belong to well-established companies that have reached a level of stability and have a significant market size. These companies consistently distribute profits as dividends to their shareholders and have a tremendous track record. Since they are well established and already achieved their maturity peak, the stocks of these companies have less growth potential than other growing stocks in the market. There are two categories of dividend stocks: dividend growth stocks and high dividend stocks. Dividend growth stocks are those stocks that have a larger potential increase for future dividend rates. On the other hand, high dividend stocks are those stocks that may or may not increase the future dividend rate, since they're paying out a high rate of dividends to shareholders. But why should you consider investing in them? 1. A great source of passive income. Investing in dividend stocks is a great way to generate passive income. Dividend payments are typically paid out quarterly and can provide a steady source of income for investors. Dividend stocks can be held in retirement accounts such as IRAs or 401ks, which allow them to grow tax-free over time. This makes dividend investing an attractive option for those looking to supplement their income or fund their retirement. Dividend payments can also be reinvested to purchase more shares of the company. This is known as a dividend reinvestment plan, DRIP. DRIPs allow investors to accumulate shares of stock over time without having to pay commissions each time they buy more shares. This can be a great way to increase your holdings in the long run and potentially earn larger dividends in the future. 2. Dividends offer tax advantages. When it comes to investing, taxes can play a significant role in the success of your investments. Fortunately, dividends are an investment strategy that offer many tax advantages. Dividend income is generally taxed at a lower rate than regular income, making it an attractive option for investors. This lower tax rate makes it easier to keep more of your money in your pocket instead of paying higher rates on other types of income. Additionally, qualified dividend income can qualify for special tax treatment. Qualified dividends are those that are paid by U.S. corporations or qualifying foreign corporations and meet certain other requirements. Qualified dividend income can be eligible for the long-term capital gains tax rate, which is much lower than the regular income tax rate. Per the IRS, for individuals whose ordinary income tax rate is in the highest brackets, 35% or 37%, qualified dividends are taxed at only a 20% rate, and for individuals whose ordinary income tax rate is below 12% to 35%, qualified dividends are taxed at 15%. And for those in the 10% or 12% tax brackets, they pay no tax on qualified dividends. It's also important to note that dividends paid by mutual funds or exchange-traded funds, ETFs, may not qualify for these tax benefits. Therefore, it's important to make sure you understand how your investments are taxed before investing in any fund or stock that pays dividends. 3. Dividends help you fight inflation. Inflation is one of the greatest threats to investors and their investments. Over time, inflation erodes purchasing power and drives up the cost of living. Dividend stocks are an effective way to combat this financial peril. While the inflation rate is increasing day by day and making an upward trend, it's essential to make effective and inflation-proof investments. An investor can achieve this by investing in dividend stocks, especially in high dividend growth stocks. When you purchase a dividend stock, you're essentially buying a share of ownership in the company. This entitles you to a portion of the profits generated by the business, which can be used to generate income or reinvested into the stock. As long as the company continues to pay out dividends, you will continue to receive a regular income stream, regardless of inflation. What's more, companies may even increase the amount of dividends they pay out over time. This helps to ensure that your purchasing power doesn't diminish as quickly as it would without dividends. In addition, if you choose to reinvest your dividends, you can benefit from compounding returns. As inflation raises the price of goods and services, dividend stocks can rise in value too, creating potential for long-term wealth. 4. Reducing risk and volatility. One of the most attractive aspects of dividend investing is that it can reduce risk and volatility. Since dividend investors are focused on dividends and not on capital appreciation, their investments will be more stable than those of non-dividend investors. This makes dividend investing a great choice for those who want to reduce their risk and volatility while still achieving an attractive rate of return. Dividend stocks tend to be less volatile than the overall market as they pay out a consistent portion of their profits as dividends. This means that dividend investors are exposed to less fluctuation in their returns due to market movements. Furthermore, dividend stocks tend to have lower price-to-earnings ratios, which further reduce volatility. Studies have historically shown that dividend-paying stocks outperform non-dividend-paying stocks during bear market periods. While an overall down market generally drags down stocks across the board, dividend-paying stocks usually suffer significantly less decline in value than non-dividend-paying stocks. However, that trend did change of late. There have been 3 bear markets over the last 20 years, with dividend stocks outperforming during the first 2. But during the most recent, amid the coronavirus pandemic, dividend-paying stocks underperformed. Meanwhile, dividend-paying stocks did outperform during the other 2 bear markets, the tech bubble burst of the early 2000s and during the financial crisis. As well, dividend stocks have proved to be less volatile. Per a Merrill Lynch study, stocks with a history of steadily increasing dividends outperformed non-dividend paying stocks from 1990 to 2018 with less volatility. 5. Dividends are helpful in equity evaluation. Just as the impact of dividends on total return on investment is often overlooked by investors, so too is the fact that dividends provide a helpful point of analysis in equity evaluation and stock selection. Dividend payments provide investors with insight into the financial health of a company. By studying dividend payment history, investors can get an understanding of how well the company has managed its finances and growth over time. Most financial metrics used by analysts and investors in stock analysis are dependent on figures obtained from companies' financial statements. The potential problem with evaluating stocks solely based on a company's financial statements is companies can, and unfortunately sometimes do, manipulate their financial statements through misleading accounting practices to improve their appearance to investors. Dividends, however, offer a solid indication of whether a company is performing well. In short, a company has to have real cash flow to make a dividend payment. Dividends can also help investors evaluate the potential upside of a stock. When a company pays out a high dividend, it could indicate that there is a lot of cash available for distribution. This could be an indication that the company has significant profits or has a large amount of cash on hand. An additional benefit of using dividends in evaluating a company is that since dividends only change once a year, they provide a much more stable point of analysis than metrics that are subject to the day-to-day fluctuations in stock price. And that's a wrap. I hope you found this video on reasons why you should become a dividend investor informative and insightful. Investing in dividend stocks can be a great way to build long-term wealth and generate a steady stream of passive income. Remember, investing always comes with risks, and it's important to do your own research and seek professional advice before making any investment decisions. But if you're willing to put in the time and effort to learn and make informed decisions, dividend investing can be a rewarding and profitable journey. If you enjoyed this video, be sure to like and subscribe to the channel for more great content on investing and personal finance. And as always, thank you for watching.